Hey everyone, hope you're having a good day. My name's Andy, our channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, and see what people are sharing. If you want to follow me, it's at @Finance. If you want to join our community, findinghypevalue.com. We've got midweek updates on Wednesdays. We have question and answer sessions on the weekend. I do training. I talk about strategies, training on technical analysis. We do go through some of the fundamentals on companies, looking at net income, looking at earnings per share, looking at certain things with their balance sheet of debt. And we go over all that. So if you're hungry for learning about investing, this is where I would go, and I would try to get as much information from me as possible that I've learned through my journey. May Day coupon code is still active for those that want to try it out. You can also swap to the yearly membership, whoever you are, using that coupon code for further savings. Colin Robertson says, sometimes I feel like high mortgage rates just distract us from high home prices. And we never really discussed it unless you explicitly exclude mortgage rates from the conversation. So it says, besides mortgage rates, what factors, if any, would play a role in your financial decision to purchase a home? Select all that apply. And it says home prices coming down. Well, that's the only other factor in affordability. I mean, the two factors is house price times your rate equals your payment. So besides your mortgage rate payment, or besides the mortgage rate, what is the factor? Well, it's home prices. That means people have big enough down payments. They're just waiting for home prices to come down or mortgage rates to come down. And that's, I mean, that's kind of like duh. I mean, that's the equation of affordability. And it says sometimes I feel like high mortgage rates just distract us from high home prices. Well, does this just seem obvious to me? I mean, this was things that I learned maybe when I was, I don't know, like 12 years old, 13 years old. This is like basic math. And I think, I don't know what it is, but there's a lot of things that I see that I view in this world to be very obvious to me. And then I look around and people are just doing like full stupid all the time. And I don't understand it. I cannot rationalize any of it. And it's like those sayings that they have where someone locks their key in their door. They've got a wire hanger. They undid a clothes hanger that's made of wire, trying to fish and get the lock undone. And someone asks you like a stupid question like, "Did you lock your keys in your car?" And you're just sitting there like staring at the person like, "Gee, oh yeah, like I'm just doing this for fun." I don't know. I just think this is like an obvious one. I just read through it. I'm like, yeah, duh. I don't know what other information you can get from this. I mean, if affordability is the issue and you lock in and say, besides the mortgage rate, well, of course, home prices coming down is should be your number one answer. I want to talk about one other thing too. I was watching Family Feud a few years ago. Maybe this might have been like 10 years ago. It was a while back. And this is what blew me away. They asked the people there, what is the largest state in America? And the number one answer wasn't even the real answer. The number one answer was Texas, and the real answer is Alaska. And I'm just looking at this like, oh my God, we've got problems. And there were four answers. It was California, Florida, Texas, and Alaska. And I just shake my head like, oh my God, what is going on here if you don't even know that? High heat. World continues to use more oil from an aging base. Discovery of oil peaked 50 to 60 years ago. 104.4 million barrels per day. So here's another thing that I don't understand. We've got people coming out. I think it was Doomberg who said, oh, we've got all this oil in the world, blah, 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 blah. Shove it up the yin yang on that. Guys, have you guys looked at how much oil we are finding? We are using 4 barrels of oil for every 1 barrel we are finding. It's either 3 or 4 barrels that we're using to every one that we're finding. That hasn't changed. So how could we be in abundance if we're using far more oil than what we are finding? That means we are running massive deficits every single year. And then every single year that goes by, we are eating through inventory levels. And that inventory level could be the reserves in Earth. Now, yes, technology is going to increase those reserves and things will get a little bit bigger with time. But that does not mean that we are finding more oil than what we are using. That hasn't happened for like 40 or 50 years. We've been using more oil than what we've been finding for 40 or 50 years. So now all I'm looking at is, okay, when is this turning point going to come? When are we actually going to peak out? And then you look at the numbers. You go and you look at the numbers, and we used to report oil and oil only, different grades of oil. Now we're putting natural gas liquids in. Now we're throwing all this other crap in. And it's like, we probably already peaked in oil. And now we're going to peak probably in natural gas liquids on top of oil within the next 5-10 years. That's my guess. Now, a lot of people have been talking about peak oil. From 1970, conventional peak oil happened in the United States. We've never been able to produce more oil from conventional oil. No matter how good technology has gotten, it has declined ever since. Now, we use shale oil and these other classifications of oil that we are going from. So the way that I view this world, the way that I view all this, is that we are going to clash between credit creation, which is keeping the financial system alive, which needs exponential credit growth, versus what keeps it in check is gross domestic product, which has an R squared value of 99 point something percent to oil increasing. Now, if we do hit oil constraints, that's it. Your currency is done because your GDP can't keep pace and you're going to go into a massive inflation. I think we've already hit that, how can I say it? The relativity between credit creation and GDP growth due to oil production, I think we've already hit a tipping point. And that's why we're seeing inflation as big as it has been from 2020 onward. Because the credit creation and the slope of growth of that credit creation against the supply of oil, which is inflation, the difference between those two, is already occurred. Now it's, when are we actually going to see oil go down? Sideways or down? A lot of people say, oh, well, it's just a function of price. No, it's not. It's not a function of price. That's like saying if I give people more money, that we will find people that can jump higher and higher. And if I give them more money, that eventually people will be able to jump 300-inch verticals. And you're like, no, there's physical constraints. I'm like, exactly. Money isn't the driver. Geological constraints and physics is your limitations. And yes, we're going to push the boundaries of what we know in physics and science. And I'm not talking about oil, just in general. But humans have never been able to create energy. We have only been able to gather energy from our surroundings. That is it. There is no other thing that we've done. We're gathering it through solar. We're gathering it through wind or pressure differentials. We're gathering it from dead fossils, which is coal, natural gas, oil, and even uranium. There's nothing else that we've been able to do. We've never been able to create energy from nothing. Now, is there something like fusion that we can create? I don't know. But that's kind of where my head is on this. Monish Pabri said, our latest portfolio is very interesting. He's got Airport Holdings, Turkey, OILvs, financial services in India. That's probably a good spot to be. India is growing. And then he's got a bunch of coal, and then he's got some home builders down here. I wonder if he understands the real estate cycle. Because why would you be in coal, which is your largest? Coal is the most sensitive in these conditions to the upside. You get the biggest returns generally are in coal. And then the real estate cycle in an expansion phase, you'd want to be in home builders like he is. So really, his portfolio is more or less an emerging markets portfolio, a bunch of coal, and some real estate home builders. That's exactly what I would do and am doing in a expansion phase of real estate in America. Very similar approach. Says, I hope he's wrong for the sake of the US equity market who's gone levered all in. AI is useless. It's 90% marketing while he ignores AI for now. It says Linux creator Linus Torvalds says that AI at this stage of the game is 90% marketing with gigantic industry hype and only 10% reality right now. I would agree from what I've looked at. You got to translate ideas to designs, designs to manufacturable products, and then manufacturable products to sales. That's all of business in one big fell swoop. Now, AI is supposed to decrease the lead time of all that. And if it is successful, they're going to have AI is going to have to push the boundaries of material science because material science is what's going to unlock a lot of those complicated designs. And also, you're going to have to overcome potentially resource constraints because you can't just go from zero to infinity and say we have infinite demand for commodities to build products. Because I don't know where the edge would stop in terms of demands from humans. So you would be limited to how much energy you can consume and the commodities that you can yank out of the ground as fast as you can. If you want the full on, edge of AI. Gary says the more we spend on healthcare, the US is 4% of the global population, yet we are 70% of pharma profits, the sicker we get. The more we spend on education, the dumber our kids are becoming. The more we spend on defense, the more unsafe we and the world becomes. The more we bring in taxes, the deeper in debt we get. Any sane person would come to the conclusion that money isn't the problem. Well, I don't know about that. I think a lot of it depends on society as well. Uh, and a lot of it depends on who's breeding, I guess. It's who's breeding and what society um, puts on, how can I say it, how they prioritize who's they choose in life. Smart people are driven by genetics for the most part, IQ. Now, society and the way that you're brought up and the nutrition that you're fed will determine how close you get to peak potential of those genetics. So if IQ and how smart someone is genetic related, it doesn't matter how much money you spend. It depends on how smart the person is of the genetics that you came from. It's almost like you're born with some sort of a lottery ticket. Really smart people generally produce really smart kids because there's that 80% genetic link. What's his name? Terry Tao. He's one of the smartest people in the world. His brother is incredibly smart. I think he's got two brothers that are also geniuses. All three of them are geniuses, and they came from genius parents. Do you think that really dumb parents are going to produce really, really smart kids at a high rate of success? And I know there's going to be people who argue it. Well, I know a person who's got dumb parents who produced a smart kid. It's like, yes, I'm talking about statistical probability. Statistical probabilities is what we use for investing. And if you don't understand statistical probabilities, it's hard to argue with someone who doesn't have the base knowledge to even argue with. There's a quote, I can't remember who it came from. It says, you never argue with someone who's stupid because they'll drag you down to their level and beat you with experience. It's exactly right. You can't even argue with some of these people. You just walk along and say, yep, sure, you're right. See ya. Coming down, we've got capital light business models tend to outperform. Well, that makes sense because if you don't need a lot of capital, of course you can grow faster with less capital. And then it compounds as you go up. I don't see how that would happen any other way. Capital intensive industries, for the most part, though, are a huge barrier to entry as well. So non-capital intensive areas are easy to get into, and then real capital intensive businesses like building entire plants and steel and all that stuff is tough to get into. But remember, you can also outperform during certain areas depending on inflation and that capital intensity. Because you could also look at it not from capital intensity, but from energy, embedded energy in items. Embedded energy is the energy it takes to produce something and replicate it, and the cost that it takes to replicate that thing. So if you've got a very energy intensive, big, huge design of buildings, ships, drill ships, all of those things, then the replacement costs are going to go up vertically under certain market conditions like inflationary conditions. So capital intensive industries can also have very big bull markets if you have like day rates or you have something that you extract from mines because you can't build it quickly. It's a barrier to entry. And then your mismatch between supply and demand or inflation versus your product is really what it is. Demand comes from inflation, so to speak. It puts it into a shortage, and there's no way they can react fast enough. So it stays in a shortage for a long time. OPEC Plus said to discuss delaying supply increase by 1 month. That's going on. Metals weekly price and performance. We've got tin, vanadium up at top, and we've got palladium, manganese, platinum, silver, uranium, and aluminum taking it in the shorts last week, getting hit down. WTI versus the S&P 500. He says, I've said many times that I don't think inflation is dead. This chart makes me think that next year may mirror 73, 74, SPX dropped 50%, and oil went up 500% versus the index. Between 73 and 80, oil was up 1,000% in USD terms. Big moves ahead. And what he's got here is oil versus SPX. And you can see that this is expensive for oil, expensive for oil, expensive for oil in 1974. We came all the way down in 2000, 2001. We were at a very cheap oil price in relationship to the S&P 500. We pulled on up, we came on back. And what does this look like, guys? It's a double bottom. A double frickin' bottom. You come in, you come up top, you hit it, you come underneath, you tap it, double bottom. We've come on up off that bottom here. And now from a ratio perspective, we are still very cheap. And we can come all the way up to these levels up here. So what that means is that oil is most likely going to outperform the S&P 500. Now, I've been listening to some of these guys talk about oil and supply, the decline rates. ExxonMobil came out and said, guys, we need to spend trillions and trillions of dollars just to hold this thing basically sideways. I think there's a big problem coming in oil by 2030. The area that we will see by the latest very big moves. And I think this is going to drastically outperform. Now, the question is, we've been bailed out by shale oil. We've been bailed out by OPEC, Middle East. So in the 1970s, conventional oil hit peak. We were bailed out by the rest of the world. Then the rest of the world hit its conventional oil peak in the 2000s. We were bailed out by shale oil. Now, shale oil in America, where the majority of the growth came from, I think is going to have trouble over the next couple of years. I don't know if it's 2 years, 3 years, 4 years, 5 years. It's some time frame in a very short period. Shale oil is going to peak, and we're going to be screwed in oil production for a period of time, maybe even for the rest of my life. I don't know. We'll have to wait and see. But it looks real tight in the late 2020s. And that's what could drive this all the way up. I just don't know what will bring it back down. And some people say, well, everybody believes that the trend in motion will stay in motion. Maybe, maybe not. We'll see, is what I'll say. And obviously, we're probably going to get a recession somewhere over here. We could even, it'd be interesting to see if there's a stagflation where you get a recession and then you get a whole bunch of inflation and then oil continues to go up. I don't know. Difficult to say. Porter Stanberry, let's go over this real quick. It says, do you know the three things every single American ought to know about Warren Buffett, Bank of America, and the upcoming election? No matter what else happens, before you go to the polls on Tuesday, please make sure you talk to your financial advisor about these three issues, in his opinion. These three issues will decide whether your family thrives or suffers over the next decade. These three things are pretty much all that matters to most Americans, and yet no one talks about these issues ever. It says issue number one, stocks have never been this concentrated or this expensive. As government regulations have become a far larger portion of our economy, profits and earnings have become concentrated in smaller and smaller number of politically connected companies, especially banks. As a result, investors believe these companies' earnings will be more consistent and therefore worth more than ever before. At 28 times earnings, the S&P 500 offers current investors an earning yield of only 3.5%. This incredibly high earnings multiple, ultra-low earnings yield, is unprecedented in the equity market, as is the combined size of the 10 largest components of the S&P 500, which is 30% of the entire market. Extreme concentration plus extreme valuation equals extremely risky market. Issue number two, government spending is completely out of control, with total spending now at 38% of GDP. We are not at war. We are not fighting a depression. This size of government in peacetime is unprecedented. We've become a socialist country. More than 50% of the population in most countries dependent on direct government aid. These transfer payments now make up to about 75% of all government spending. Since the last recession in 2008, direct transfer payments have soared from $2 trillion to $5 trillion this year, mostly because these benefits are indexed to inflation. These payments, which are mandated by law and are untouchable politically, consume 100% of all tax revenue. These payments do not include the $1 trillion we owe currently in interest on our existing debt, which means we are now borrowing money to simply pay the interest on our debt. These payments, because they are linked to inflation, represent a doom loop funding problem for our government, because the more money the government prints to finance its debt, the higher these payments will go. And unlike payments to large institutions or large corporations, virtually all of these funds end up in people's checkbooks and other spending accounts, which is why M1, a measure of the dollars in circulation, has soared from $3 trillion to $18 trillion in the last 4 years. This is what's driving inflation, and the Fed hiking interest rates isn't going to stop it, because the spending doesn't depend on private company hiring or other normal economic activity. The inflation is a direct result of the government's Ponzi-like financing scheme, where it prints money to buy its own debt. This is how hyperinflation happens. And issue number three, the company that is most at risk at higher inflation is Bank of America. That's because the bank purchased over $500 billion worth of bonds in the summer of 2020, the so-called COVID bonds. As a result of the huge investment in low-yield, 1% high-duration, 15-plus-year bonds, Bank of America has been suffering from very low yield spreads. It cannot afford to offer its depositors any interest on their deposits because it isn't generating much income from these bonds. That's why domestic depositors are only being paid 0.04% on deposits. Even so, Bank of America yield spread is still only 2.2%. Even if Bank of America offered 1% on its deposits, its earnings would virtually disappear. And with inflation rising again, currently at 3.5%, BAC risks a run on its deposits unless it lifts its rates. That's exactly what happened in the spring of 23 to First Republic and Signature and Silicon Valley Bank, all of which owned similar bonds on their balance sheets that were very low yielding and thus couldn't be sold without huge losses. And that's the really scary part. As long-term interest rates rise, they've moved from 3.6 a month ago to 4.4% today. The losses on BAC's COVID bonds are mounting and most likely exceed $100 billion. As rates go higher, the losses will grow and grow. At $200 billion, the losses on these bonds will bankrupt BAC. Before that happens, though, there will be a run on BAC that will lead to yet another national bailout of the banks, and that will drive inflation far, far higher. It will also panic the stock market, which now sits at record highs. That's why Warren Buffett has been selling shares of BAC for months. It was formerly one of his largest investments of all time. And that's why Buffett has now amassed the largest cash pile of any investor in history ever, 325 billion in cash. If your financial advisor isn't aware of these risks, if they haven't been warning you to build cash reserves or even better, gold and Bitcoin reserves, they don't deserve your trust or respect. These are real and critical risks to the economy, our stock market, and even our way of life. Risks of this nature and of this size typically lead to major political and social upheaval. Debts of this size lead to war. No one will want to pay these debts, and the resulting inflation will tear our entire society apart. Neither candidate will solve these problems, and in fact, neither candidate has bothered to address them. The simple fact is, we cannot possibly afford these transfer payments, and so we must completely reorder our society. It's unlikely that will happen peacefully. But one way or another, the gig is up. Socialism only works until your neighbor runs out of money and he's tapped out. If you want to learn more about these risks and how to deal with them safely and effectively, I urge you to follow blah, blah, blah. Okay, so that's his opinions there on the three most important things. We're going to go here into gold to oil ratio. Circles are the bottom of the commodity to stock ratio. So here's the circle. So bottom of commodity stock, the top, bottom, and then we are still at cheap oil. If you look all the way to the left, we are below the entire beginning of the oil move of last bull market of 1999, where it began. We are below that level. We got to ridiculously low levels in 2020, but we've broken out of the falling wedge to the upside, and we've consolidated here for a good bit. Are we ready to go in oil? I don't know. I've been waiting for this move, and it just hasn't occurred yet, and I'm going to continue to wait for it because we are cheap. And this is what I'm using for those circles, 99, 2008, and then the other circle here. And that's those circles put on the ratio here, from here to here. And now we started that move of commodities outperforming equities, which is going to be a crude oil to gold ratio, I think, outperformance coming up here whenever we turn into it. It could be next year or even late next year. Hard to say. Coming down, Dow Jones versus US CPI and when to invest into gold. So we've got these big moves. So Dow outperformed during this period. And this is, again, Dow Jones divided by the United States Consumer Price Index. I've got gold on the bottom here. Dow outperformed, and then you wanted to swap into gold in the late 1960s, and you want to hold gold all the way. So gold went way up, Dow went way down against the Consumer Price Index. As we go up, you want to be in the Dow. Gold is where you wanted to be when Dow Jones went sideways against Consumer Price Index, and gold ripped it from 2000 all the way up to 2011, 2012. You wanted to be in Dow coming on up. And I think we've probably ended that move. We could potentially be going down here in 2022. And I didn't put a line there because I didn't know when to start. And when you look and you're going through it real time, it's hard to know. So if we see a sharp downward move where Dow Jones underperforms United States CPI, I think gold's going to outperform. And it's also the least risky asset. Another thing that we can look at is Dow Jones when you price it against gold. So Dow Jones, you can see we rotated in, let's go up here. It just turned in the late 60s, which also occurred here in the 65. We were underperforming the consumer price index there, Dow Jones was. And then we also rolled over against gold. So gold was a complete buy here. It was also a complete buy in the early 2000s when it rolled over as well, which we can see in the 2000 is when it went sideways here, and that was when gold started to take off. I think we're in the same exact situation today. I think we're going to roll over in Dow, and I think we're going to go up in gold. And we're seeing that breakout in Dow Jones versus gold already right here. It's just breaking down. So I think that we're probably going to see it break down against the US CPI here in a second. And gold's already been ripping higher. So, and again, could the Dow Jones go up at the same time that gold goes up? You could if you've got massive inflation and the dollar really, really drops. That is still another potential possibility. Platinum versus US CPI, silver and oil versus US CPI. So look at the early 90s. We had that big bull market start for commodities to outperform equities, which is in 98, 99. And it's still based out, doing that basing out right now. So this area in the late 90s is this same move in the 2020s here, 2010 or 2019, 2020 onward. And then I think we're going to get a big breakup of platinum versus the consumer price index. Here's another one here, silver versus the consumer price index. That's already broken out and it's running already. Looks fantastic for silver. And then oil versus the consumer price index. We had a huge bottom in 1999 versus the consumer price index. We've broken out and we had the three wave move higher, up three wave moves. So wave one, wave two, wave three, wave four, wave five is what we call it. The consolidation, we have wave one and then wave two, and we're still trying to bottom on wave two for crude oil versus CPI. That's currently where we're at. Gold versus the Fed funds rate declines and unemployment rates. And you can see gold goes up when the Fed funds starts to cut rates and when unemployment goes up. So that happened. And then look at gold rip here. We had another one here. Gold just kept ripping. And then we had a period of time where we consolidated and unemployment rates stayed really low. We had another spike here, both in Fed funds rate declining and spike in unemployment. And you can see gold really took off there. We had a sideways consolidation, and now we could be getting a Fed funds cut rate and unemployment potentially going up and gold ripping again. Oil prices against the Fed funds rate declines and unemployment rates. I was seeing if there's a negative correlation or if crude oil sells off. Yeah, there's a little sell-off here going down, probably a 50% drawdown there. We have another big drawdown here. And then we could get another drawdown if this results in a recession or problem. There could be a drawdown. So that risk still exists in oil. S&P 500, the Fed fund rates decline. You can see how this moves with it. We've got a decline here in 2000 and stocks declined. We had a decline in Fed funds rate in 2007. We also had a following decline in stocks. We had a decline here in 2019, 2020. There's that pullback. And then we could potentially be declining here any second. We'll see if we get a pullback in the S&P 500 again. And this is where all those bearish calls are coming from. We don't want the Fed funds rate to go down because that's generally bearish for the S&P 500. And this is the evidence, at least over the past 25 years, showing that. And that's what we got for today, guys. I didn't go over this one, but active housing inventory for sale compared to pre-pandemic levels. I just thought this was interesting. Some people live in the Midwest or the East, and they're saying the housing market's super tight. It's because your active inventory is down 61% in Illinois. It's down 46% in Wisconsin. It's down a whole bunch in the Northeast. But if you look at where I'm located, we're up 7% here versus October of 2019. So the market here is basically normalized for the most part, but we still are very tight in the Midwest and on the Northeast for housing. And that's where I'm going to end it, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you next time. This is Finding Value.